On July 2, 2026, the surface of the global financial world suggests an environment of massive, uninterrupted growth. This chart tracks global mergers and acquisitions over the last decade. In just the first 6 months of 2026, deal-making has hit a record $2.8 trillion, showing a high level of corporate confidence in the long-term economy. Consumer pressures are showing signs of improvement as well. Eurozone inflation has begun to ease, suggesting that the era of aggressive price hikes in Europe may be nearing its end. Even energy costs are providing relief. Brent crude has dropped to a 4-month low as U.S.-Iran diplomatic signals improve and shipping flows recover, reducing a major source of global inflationary pressure. Record high investment, cooling global inflation, and cheaper energy. These traditional indicators paint a picture of a global economy stable and positioned for expansion. However, in Asian markets, that stability is being replaced by a wave of anxiety that is quickly erasing recent gains. After months of growth, investors are aggressively selling off technology shares. Specifically, semiconductor and hardware companies in South Korea and Japan are seeing significant price drops as traders move to lock in profits. We are seeing erratic movements in other markets too. The US dollar is losing value, while gold prices are climbing, as investors move money into assets traditionally seen as hedges against uncertainty. This creates a clear paradox. Long-term economic indicators are positive, yet the current behavior of investors is defensive and cautious. The reason for this paralysis is a single piece of American data scheduled for release today, the U.S. non-farm payrolls report. The U.S. Federal Reserve effectively sets the baseline cost of borrowing for the entire world. When the Fed moves, every other market reacts. To decide whether to raise or lower interest rates, the Fed looks at the non-farm payrolls report to determine if the American labor market is running too hot or too cold. The logic follows a specific balance. If the report shows high job creation, it signals a heated economy that risks higher inflation. This forces the central bank to keep interest rates high, which makes it more expensive to borrow and invest. A weak jobs report does the opposite. It provides the justification the Fed needs to cut interest rates, lowering the cost of money for everyone from homeowners to multinational corporations. This employment metric acts as a global thermostat, controlling the price of capital around the world. Tech companies are especially sensitive to these rates. They require massive amounts of borrowed capital to fund the research and high-end infrastructure needed for expansion. The current push for advanced computing and data center growth is particularly dependent on this cycle, requiring continuous billion-dollar investments in semiconductor hardware. The fear that interest rates will remain high is causing investors to question if this level of infrastructure spending can be sustained. This doubt is what is driving the current sell-off in technology stocks. The pace of technological expansion is currently tied directly to the strength or weakness of the American labor market. When investors face a situation with two very different potential outcomes, they often move their money into safe haven assets, investments that typically retain their value during market swings. We are seeing this right now with gold. Prices are rebounding as institutional money migrates into the metal to wait out the volatility of the U.S. labor data. Currency markets are showing a similar shift. This graph shows the divergence between the US dollar and the Japanese yen, as speculators buy up yen on rumors that Japan may intervene to support its currency. These shifts in currency and commodities signal a global market bracing for impact, moving capital away from productive investments to protect against a potential shock. The market is currently waiting for the release, with trillions in capital ready to move based on the final numbers. Strong jobs data triggers scenario A. The dollar and bond yields rise, dropping tech stocks. But if the report is weak, scenario B takes over. Rate cuts become likely, the dollar softens, and the tech rally restarts as borrowing costs fall. There is very little middle ground. Once the data is public, capital will reallocate across the globe within minutes. This interconnected dynamic clearly highlights exactly how the modern global economy functions as a single, highly sensitive nervous system. Even with a record $2.8 trillion in mergers and the decrease in global energy costs, the influence of a single American labor report remains immense. While strong corporate deal-making and cooling inflation are positive signs, they currently lack the power to drive market momentum on their own. Despite the growth of high-tech infrastructure and a globalized supply chain, the immediate movement of global capital still rests on the specific path of American interest rates.